Hello and welcome to ET Now. I'm Ashwin Mohan and you're watching Amicus Curiae, where we get you news and views that you can use from the world of corporate law, tax and regulatory affairs. And this week we take a closer look at the government's decision to roll out draft guidelines on foreign tax credit rules. And of course, we're going to analyze the implications of these new rules. How is it going to change the dynamics between the taxpayers and the income tax department? How is it going to in fact provide relief, and whether or not there are any grey areas that need to be ironed out. And to throw more light on that front, we're joined by two voices from the world of tax, C.A. Gupta from Deloitte and Riaz Thingna from Grant Thornton. Gentlemen, thank you so much for taking out time and joining me on the show.
Pleasure.
Let's start off with you. Help us understand how was the scenario different before these draft guidelines came out, and in the absence of these foreign tax credit rules, norms which have been proposed. Of course, the government has invited comments as well. What were some of the practical difficulties being faced by some of the corporates?
So, prior to the draft rules being published in a way, the issue was there was no uniformity with respect to the claiming of foreign tax credit. Now, for example, as to whether surcharge and education cess were they eligible for foreign tax credit, or the timing as to when the foreign tax credit should be claimed, in the sense the conversion as to how the foreign tax credit should be converted, and then so on and so forth. So there were a number of issues with respect to the eligibility of foreign tax credit. The draft rules have provided some clarity with respect to some of those aspects, not necessarily with respect to all those aspects. So in a way it is welcome to address some of the open issues, and which were mostly based on judicial precedent, but it still leaves some areas open where the clarity has not been provided.
All right, we're going to go on to those areas a little later in the show. Riaz, preliminary comments from your end. Could you illustrate with a few examples how things were different for some of your clients in the absence of draft foreign tax credit rules?
Sure. There has been ambiguity to begin with. So claiming credit for those foreign taxes was always an issue, subject matter of litigation. Tribunals have come up with various decisions, particularly, as CS says, on the issue of credit against MAT paid by Indian companies, or against surcharge and cess. The documentation part was always a problem. That also has been substantially taken care of. But as, again, taking off from what CS was saying, there are some other areas which need to be addressed, and which I guess will come up as a part of comments from all the stakeholders to the government.
All right, now let's look at the nitty-gritties. According to the new draft rules, credit will be allowed for the amount of foreign tax paid by entities or individuals in an overseas jurisdiction, with which India has an agreement for avoidance of double taxation of income. In fact, it's not just limited to those countries, but all countries.
Sure.
Now, according to the draft rules, it says the credit will be available against surcharge, cess and minimum alternate tax payable in India. How much will this contribute towards ease of doing business?
To some extent, yes, because again, with respect to litigation on whether foreign tax credit can be claimed on surcharge and cess, that would probably be done away with the new rules. Likely with respect to minimum alternate tax, the only area perhaps on minimum alternate tax could be the mechanism or the quantum of the credit which will be available against the minimum alternate tax. The rules do provide basis on which the foreign tax credit can be claimed against minimum alternate tax payable. To what extent that will be binding on the taxpayer, and what will be the impact of that be something one will need to look at. But the rules try and do indicate that the manner in which the foreign tax credit will be available against a minimum alternate tax payable.
Riaz, give us a sense of the kind of litigation that has transpired because of ambiguity regarding the foreign tax credit rules. Now, of course, the draft proposals are out. Sooner or later, the government will notify the new final norms based on feedback from various stakeholders. But what kind of litigation has transpired in the interim period?
Yeah, especially for credit against MAT and surcharge and cess, there had been resistance from the assessing officer level, and credit was not being allowed. These matters did go up, and to some extent this has been settled recently with various tribunal decisions.
All right.
So to a large extent, that issue of credit being allowed against cess and surcharge as well as against MAT has been decided by the tribunals, and I think this just reiterates the tribunal decisions.
So this move will definitely reduce any potential litigation, this move by the government?
Sure, whenever you have powers in the decisions, this matter had reached a certain level of equilibrium, but definitely it will reduce the chances of any further litigation.
How will this change the dynamics between the taxpayer and the income tax authorities? There's always been a difference of opinion on this particular aspect. We'll look at some of the other details in a while, but how do you think the entire relationship is going to change?
Well, I think that to some extent that dynamic will always remain, for the reason that one of the condition under the draft rules is that in order to claim the credit, there are certain documentation requirements that need to be complied with.
And you also have to make a disclosure.
You have to make
about
a disclosure
the amount of foreign tax.
Right.
That the amount of foreign tax is
Not
on
in
which you are claiming credit is not under any dispute.
So there are two key things. One is, as you rightly mentioned, you have to make a disclosure that is not disputed. Second one, there is a documentation which you need to provide from overseas tax authorities about the amount of foreign tax paid and the nature of the source of income. Now that's going to be a key challenge, because that's a unilateral requirement which the tax authorities in India have in that sense imposed. And that's not necessarily binding on the overseas tax jurisdiction. To what extent those certificates will be issued by the overseas tax officers, that is something one will need to be seen. Of course, to the extent there is a tax withheld and the payer provides a certificate, there is a provision that can be relied upon. But to the extent one has to get a certificate from the overseas tax officer, particularly with respect to the source of income and the nature of source, that's going to be a challenge.
Do you concur with him? Do you expect similar challenges?
Yes, in fact, I also see a big challenge in the difference in financial years. So we follow the April to March financial year. US, for example, will be following the calendar year. So income earned between January to March of, say, 2016, taxes on that would be paid by in USA sometime in 2017 after the tax return has been filed. So how will the credit of that tax be allowed here? The rules are silent on those aspects. So
So can it be safe to assume that, taking off from what CA said, can it be safe to assume that companies who are linked with non-treaty countries will find it troublesome to get the documentation that has been classified under the rules? Because with treaty countries, I'm assuming there should not be too much of a problem with getting these documents from the tax authorities over there.
No, it will be with both the cases, because this is unilateral requirement which India has imposed in that sense under its domestic law. And that is not necessarily binding on the overseas tax officer, whether it's a treaty country or not.
So do you think there is a requirement to simultaneously also include this aspect in various treaties? To avoid any administrative challenges?
So maybe the exchange of information requirement or article and so on. So to the extent it can be incorporated in the treaty itself, which means both the countries have negotiated and are on the same agreement with respect to those documentation, certainly it will go a long way in reducing the challenge for the taxpayer.
But until that is done, you expect some sort of you expect some challenges at least to get these documents.
Absolutely.
All right, point taken. Now the draft rules also have some riders. For instance, the credit will not be provided for other sums such as interest, fee or penalty or taxes under dispute. Is this a dampener of sorts, or perhaps are we expecting a little too much from the government?
No, not really. I think that was already accepted, that well accepted fact that you can get credit of the taxes paid. And that, to the extent Sarjan says, is incorporated. I think that is good. But interest, fee and penalty, I think they were never as part of taxes. So to expect that should be covered as part of foreign tax, I don't think that was...
Perhaps expecting the government to be a little too generous.
I agreed.
Riaz, what's your take?
Yeah, I will agree on the not permitting credit in terms of interest, penalty, etc. Because those are penal provisions for default, so you can't possibly expect credit. But over there, there is also one inclusion of tax under dispute. Now, tax under dispute, that requires a closer look, because if there is a tax under dispute, what will happen is that credit will not be given here. By the time the dispute is settled, assuming that the dispute is settled in favor of the assessee, there may be a challenge in claiming that tax credit at a future date. So I think some clarity will be required for tax under dispute. That should be separated from the other aspects of interest and penalty that we spoke about.
All right. On the more positive side, don't you think the rules or the proposals in their present form will make it easier for the tax department to measure foreign tax credit and also, in fact, identify the eligibility criteria, or at least closet people into various categories? At least from that point of view, do you think this streamlines the current regime?
Sure, certainly, no doubt about that. And for example, now they've made it very clear, okay, the date on which you paid the tax, the date of the payment of tax, the SBTT buying rate, on that rate will be the date which you will qualify for the conversion of the taxes. So that way they have provided a few clarities with respect to various aspects of the foreign tax credit, which is basically emanating from the judicial decisions either of the high courts or the tribunal. So to that extent, certainly it will help insofar as the reducing litigation and ease of doing business, as one may say, and the interactions between the taxpayer and the tax department.
Here's the documentation aspect plus the fact that there is a disclosure required that the amount on which you're claiming credit, amount of tax, is not under dispute. Do you agree with him that this will perhaps make it very easy for the tax department officials to at least classify the SSCs and then start identifying them and in fact asking them for the required information?
No doubt about it. This is a step in the right direction. It is leading to reduction in ambiguities, providing much needed transparency and clarity. And, because we've always found that ambiguity of any sort, wherever you give subjective powers or discretionary powers to the assessing officer, they're prone to misuse. So that will definitely be reduced, and it's going to make things a lot easier. Some areas, as we said, need a closer look. Maybe some of them will be handled after the comments from the stakeholders come in by the government. And we hope that some of the larger items are included in the final rules that emanate from here.
All right. On that note, we'll have to slip into a short break. Stay tuned to ET Now and keep watching Amicus Curiae. Welcome back to Amicus Curiae, where we are discussing the implications of the new draft foreign tax credit guidelines. See, if you look at one aspect of the new draft rules, and I was speaking to a few people in the community, your peers, and some of them told me that these rules, they contemplate a source-by-source and a country-by-country basis for computing the FTC. Do you think that this is a little too complex? At least that's the feedback I got from them. And do you think there's perhaps scope for there to be some confusion?
Quite possibly, for the reason that different countries will characterize income differently. So if a foreign jurisdiction was to characterize a certain income as a business income or a capital gains, and India was to characterize it differently, whether the tax officer will take a view that your sources are different and therefore credit is not available, point number one. Second one will be as to whether you need to follow country by country approach or a pooling of country approach. Now that could cut both ways. In some cases it could be advantageous to the taxpayer, in some cases it may not. And as to whether you need to give an option to the taxpayer as to which approach they need to follow. So there will be a number of examples in this context, particularly in respect of the source context, where the characterization could vary from country to country, and that will have a bearing on the foreign tax credit. And therefore, if some easing on that could be done, I think that will really be helpful.
Riaz, how can the draft rules be simplified, at least in this aspect?
Yeah, so let's divide it into two parts. One is country by country, and the other is source by source. As far as country by country is concerned, let's face it that we live in a complex business environment. So today, goods can be manufactured in UK, finished in USA, and then packaged in Singapore. Now, each of these countries will have different rates of tax, will have different treatment of income. So we can't really pool all countries together very easily. It will lead to various instances of tax leakages. So it's a far more difficult task to deal with country by country pooling. As far as source by source is concerned, I think there is a strong argument there, as CA also puts it. We need to ensure that the entire foreign tax credit that is available from income earned outside the country should be available for credit against the country in India. So pooling of sources of income would, I think, to my mind, be a good solution to at least address this particular issue.
All right. Now let's look at some of the aspects which have not been covered. If you look at the draft rules, the rules do not make any provisions for carry forward of excess foreign tax paid. Neither do they address the issue of branch profits tax paid by branches of Indian companies overseas. See, how big a concern is this?
So insofar as the first point is concerned on the carry forward of the foreign tax rate, that certainly could be a concern in cases where you have an Indian entity which is in a loss position and its overseas operations are profitable, where you are not able to claim the foreign tax credit because you're not paying taxes in India or the taxes paid are less than what you're eligible. Now, in that context, I think the foreign tax credit eligibility could be, they could modify to either carry back or carry forward, which is precedent applicable outside as well. That will perhaps be very helpful in that context. Insofar as the branch profit tax is concerned, I think it's probably India has a treaty with US is the only country where they have this concept of branch profit tax or permanent establishment tax. It would be good if they could clarify it, although I don't think there has been significant challenges on that. But I think, yes, some clarificatory provision on that a branch profit tax paid outside India is also eligible because it partakes the same character of income tax as such, and there should be no reason why that should not be eligible for a foreign tax credit. But a clarity on that, I think, will be really helpful.
Yes, this was bound to be picked up by the tax community. Why do you think the government has not bothered to include these in the draft tax guidelines?
Well, there are certain complexities involved. So if we speak about branch profit tax, so typically what happens is that the branch profit tax is paid at the time of remittance outside the country, in a lot of countries. Now, where India is concerned, the Indian entity would be required to declare income on accrual basis. So the income is earned, accrued in India, subjected to tax, and the branch profit tax may be paid in the subsequent year. So that credit, so there are complexities involved. On carry forward, I think there seems to be a slip because a lot of countries allow for foreign tax credit. US, UK, Singapore, I think all these countries do allow carry forward of foreign tax credit. Now that is something that I think needs to be looked at urgently.
If you look at some of the expat employees, let's move away from merely the corporates and also look at how this might impact the expat employees. Do you think there's a need to amend section 192 relating to TDS? And this is, of course, to allow taking the foreign tax credit into account while deducting tax from the salaries of the expat employees. Do you think this has to be done?
Yeah, it is required for the reason that you see the deduction of tax at source from salaries is governed by 192, and there is a circular which the CBDT issues on a yearly basis as to what are the methods and policies to be adopted in the deduction of tax at source. Now, in that circular, they never address the issue of the foreign tax credit. And obviously, the companies will be apprehensive of considering that while deducting tax at source, for the reason that if they don't deduct tax appropriately, then they will be in default.
And there are many MNCs with many expat employees working here.
Absolutely. Yeah. And therefore, if the both sections can be amended and therefore clarity can be provided that a foreign tax paid in jurisdiction outside India can be considered while deducting tax at source from salary, I think really will be helpful. And not only that, the whole treaty benefit whether can be considered at the time of deduction of tax at source will certainly be helpful. And now in the context of mobile employees where an employee may be in different jurisdictions during the year, and if he has tax deducted in each of the jurisdiction, he will perhaps be out of pocket in some sense as such. So that's a real dire need, I would say, of amending both section 192 and providing clarity on that aspect.
Yes, I'm assuming you concur.
Yeah, but just to add, this is more important for Indian employees working outside India rather than the other way around, because the rules would be more applicable to them. And it can be a very serious problem because you could have as much as about 60% of your income being absorbed by taxes and then credits to be claimed, refunds to be received thereafter. So yes, but so more than the employees, expats coming in, it will affect expats going out from India.
All right, point taken. What about underlying tax credit in respect of dividend income? That aspect also hasn't been addressed in the draft guidelines. How do you think this can be addressed, this entire issue can be addressed?
So both in the context of the underlying tax credit on the dividend income as also on the tax sparing, wherever the treaty provides, there is this eligibility to claim both the underlying tax credit and the tax sparing, and the guidelines don't address that. And I think it will be good if they could factor that as well and provide some framework where the companies will be eligible to claim both the underlying tax credit and the tax sparing. I think that will again go in reducing the litigation or reducing the interaction with the tax officer's viewpoint and the taxpayer's viewpoint.
Yes, what's the ideal framework that can be incorporated over here in the final norms?
So in the final norms, as we already have existing provisions in certain treaties, Singapore, Mauritius, Oman, I think, and various other countries, I think we should take from those treaties and incorporate into the rules for clarity.
In fact, now that you're talking about overseas jurisdictions, how is this entire aspect of foreign tax credit looked at overseas. What's the international precedence here?
So on the international precedent, one aspect which we refer to, for example, countries like US, they provide a tax credit 1 year back and 10 years forward as well. So in the sense, and that's rightly so, for the reason that, as I said earlier, if you're in loss position in year 1 and you're not able to absorb your foreign tax credit, there is no reason that in year 2, when you become profitable, you should not be eligible to claim the excess foreign tax credit. So that's one precedent with respect to the foreign tax credit, which is prevalent, I think, by and large in most of the countries, which I think should be adopted as part of the foreign tax credit mechanism.
Riaz, would you like to add to that?
Another issue also is this tax sparing provisions, which are available in some of the local jurisdictions, and underlying tax credit norms also that we referred to earlier. So there are precedents where the domestic laws of these countries actually incorporate these areas that we've been speaking about, which could continue to be niggling issues in the future.
All right, gentlemen, it's time now for closing comments. The government is eagerly looking forward to feedback from experts like you, so that the final norms will be beneficial both for the department as well as for the SSCs. So, CA, your top 3 list of suggestions that you would like to make to the government.
Changes in the documentation regime. State income taxes, wherever they are not considered, should be considered, like income tax in the US paid at the state level. And third one would be on the clarity on the source by source.
What about you, Riaz? Top 3?
Yeah, clarity on treatment under different financial years, tax sparing provisions, and carry forward of foreign tax credits.
All right, gentlemen. On that note, I must thank you both once again for taking out time and joining me on Amicus Curiae this week. With that, it's a wrap on this edition of Amicus Curiae. Thank you so much for tuning in. This is Ashwin Mohan signing off. See you next week.